Hello, everyone. I appreciate your patience. We're going to get right into it because I know we're a little bit late. Once everybody who was in the waiting room has a chance to connect, which should be another few seconds, we'll get right into it. I appreciate your patience. All right, I see people loading in steadily. All right, without further ado, we're just gonna jump into it. All right. Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar. Avoid costly mistakes. Top 5 syndication pitfalls every passive investor must know with Alina Trigub of SAMO Financial. As a quick note, please be aware that we'll be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of that dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity, and we believe that you should always do your own due diligence before investing your money, whether it be retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. And lastly, here's my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass the controls over to you, Alina.
Will, thank you so much to you and to Camaplan for such a great introduction and for hosting me. I'm excited to be here. Hello, everyone. As Will mentioned, we're going to be talking about top 5 syndication mistakes that passive investors make. I would like this presentation to be somewhat interactive. Will did say that I'll answer questions at the end, but feel free to post them in the Q&A. And I will look through them, or even unmute yourself if that's an option. I think it is. So let me begin the presentation. Hopefully I can share my screen. Will, can you please confirm you can see my screen?
Yes, it looks good to me.
Okay, perfect. Thank you so much.
Of course.
So I'm sure a lot of you want to know what those top five syndication mistakes are. And while some of them may sound familiar to you, the point of this presentation to go through these mistakes and also offer you some suggestions as to what you can do to avoid these mistakes, or if they do happen, to mitigate them, and kind of what you can do to work through it if you're a passive real estate investor. And of course, my attorney wanted to share this fine disclaimer with all of you. Will read his. I'm not going to read this one. Please read it on your own. But this is for educational purposes only. We're not providing any advice, not soliciting, not selling anything. So as we go through this presentation, I want you to keep in mind that over 60% of passive investors lose their money on their first syndication, and primarily because they make very common and very avoidable mistakes. I have been in your shoes as well. When I started investing 8 to 9 years ago, I wasn't sure what to look for, where to look, what questions to ask. And that's primarily why I'm here today, because I want to share with you the 5 most common pitfalls that passive investors make. I'm also going to be sharing real life investor stories without mentioning any names. And at the end of the presentation, I will provide you with actionable frameworks that you could use so that you could invest with confidence. So pitfall number 1, poor sponsor due diligence. One of the biggest mistakes that investors make is they focus solely on property and not evaluating the sponsor properly. You have to look at the sponsor, their background, their team, how long they've been around, what they have been doing in the past, and there are several ways to avoid making such mistakes. Number one is research the sponsor track record. Have they exited the deals? Have they been through the downfalls? How many deals have they gone through? Has the team changed at all? Verify their past performance. Have they met or exceeded projected returns? Have they ever lost investors' money? Check their reputation. Do they have any litigation history or any investor complaints? Are there any pending lawsuits against the sponsor? Ask the sponsor for referrals from their past and current clients. The actual feedback from real investors is absolutely invaluable. And the real life example in this case, I know a physician who invested in a deal because the sponsor seemed credible, but failed to check the track record of the sponsor. What happened in the end is the investor lost 50% of their capital because the sponsor had no prior experience managing apartments. They were in the consulting field, but they never took the deal from the beginning to an end. The deal struggled, the communication was very poor, and as I mentioned, the investors lost 50% of the capital. So the key takeaway in this case, if the sponsor lacks integrity, experience, or transparency, walk away. Don't even go into further discussions with this kind of sponsor. Pitfall number 2, it's not having a clear exit strategy. So when you're evaluating an offering, usually it will say that we're planning to hold this asset for 3 years, for 5, for 10 years, whatever it is. Now, that number does not automatically entail that the sponsor will stick to it, but at least you know that for the duration of that time, the sponsor has a plan in place that they're planning to execute. And if it's a longer term, let's say it's 10 years, then you know they're planning to hold the asset for a longer term, and they've planned ahead different things that they will be executing during the holding period of that asset. And I want to emphasize the point that you can't really hold this sponsor responsible to that specific holding period, but at least you know that they've evaluated the asset and they have produced the underwriting that shows you what's going to happen during this anticipated holding period. So how to avoid the mistake of and I'm sorry, I mentioned pitfall number 3. Pitfall number 2 is chasing high returns without understanding the risk. So how to avoid this mistake of chasing high returns without understanding the risk? First of all, understand the asset, evaluate the risk versus reward, scrutinize the underwriting assumptions, and make sure that the assumptions are conservative. And if the IRR is too high, maybe it's too high for a reason. So ask the sponsor about this IRR. Why is it too high? How did they come up with this IRR? In terms of the strategies, find out what kind of strategy the sponsor is executing. Is it core? Is it value add? Or is it opportunistic, which is a very, very risky strategy? Not to say that you shouldn't execute and invest in that, but if the strategy is opportunistic, obviously the higher the risk, the higher the reward. So with that, I'll also say that it's important to know your risk profile. Because if you're willing to take a higher risk to receive higher reward, then potentially it may be for you. So the key takeaway for chasing high returns is if the deal looks too good to be true, most likely it is too good to be true. So always assess the risks behind the numbers and ask the sponsor as many questions about the asset, about their underwriting as possible. And if you don't understand the underwriting, potentially start educating yourself on it. Maybe read a couple of books, take a course, or work with someone who's done underwriting in the past and can teach you how to evaluate it. You don't have to become an efficient underwriter, but you do need to understand how to do the underwriting and how it works so that you can ask the sponsor appropriate questions. And the real life example in this case, I actually saw a deal that another investor shared with me where the projected return was 22%. It was a hotel syndication. The investor saw that the return was very high and decided to go into a deal. But the problem with that was that the sponsor relied on 100% occupancy, which was very unrealistic. This deal was actually brought up during COVID, and the hotel lost significant percentage of the occupancy and went into foreclosure. And unfortunately, the investors lost all of their money. So the main thing, the way to avoid this is, again, to assess all the risks and ask the sponsors, what are the potential risks associated with this investment? And also, what are you as a sponsor doing to mitigate such risks? Now going to the pitfall number 3, which is not having a clear exit strategy. And I apologize for the earlier confusion. So as I explained, the holding period may be anything from 3 to 5 to 10 years. It usually depends on the strategy that the sponsor is trying to execute. New constructions tend to have a longer strategy. Value-add projects tend to have a shorter strategy, more or less 3 to 5 year exits. But again, it doesn't mean that the sponsor will hold the asset for the duration that's specified in the offering memorandum. It's simply to tell you, this is what my plan is as a sponsor. And during this 5 years of holding, this is what I'm going to do. And that's how the underwriting looks like. But you do need to analyze the market conditions. You need to ask the sponsor if he has, or he or she has any other potential exit strategies, such as potentially doing a refinance, or are they would consider selling the asset sooner if an opportunity presents itself. Some sponsors like to hold the assets for the longer time, and if your plan to have the money back within, let's say, 3 to 5 years, but the sponsor wants to hold it for at least 7 years or longer, then this deal is potentially not for you because it doesn't fit your goals. So definitely consider it and ask the sponsor appropriate questions. And the real life example in this case, that investors entered into a deal without knowing what was the exit plan, and the property was tied up for over 8 years. Even though the sponsor was hoping to sell the asset in 5 years. This investor needed the money much sooner, but couldn't get out of the project because it was syndication. So they were stuck and had to wait for a much longer period of time. So the key takeaway in this case is always ask the sponsors about multiple exit strategies, and also ask them how tight they are to the timeline that they're projecting, and whether they plan to hold less or more, and also whether they foresee the market condition changing, or if they plan to change their strategies if the market condition change, and how will it change, and how do they plan to mitigate potential risks that may arise if the market condition changes. And folks, again, feel free to pose the questions. If you want to unmute yourself, or Will, if you want to ask, by all means, but otherwise I will address all the questions at the end.
Yeah, I believe it's not possible to unmute in this setup, but if they use the Q&A function or the chat, I can pose the questions that they have to you.
Sure. So, Will, if there are any questions in the Q&A or in the chat, feel free to ask now.
Will do.
Okay, I'm assuming so far no questions.
So far, no questions.
Okay, good. Pitfall number 4, underestimating capital calls and liquidity risks. First of all, I want to make a clear distinction. There are two different events, if you will, that are called capital calls. One of them has negative connotation, the other one doesn't. So let's start with the one that has positive connotation. So if you're investing in a syndication that's phased out, or in a fund, then the sponsor may potentially tell you that, hey, we don't need all of your money up front, but we're going to be doing it in phases. And as the phase comes up, when we need your money, we'll do a capital call with the date when you need to bring the money in. So this is an absolutely fine positive capital call with a planned timeline where the sponsor is phasing out bringing your money in. It could be for multiple reasons. Maybe they do new development, or maybe it's let's say a fund of funds where they bring in different projects, or investing in other syndications, and they're only bringing the money in as they need the funds to put for that next phase or for that next project. And again, it's still called a capital call, even though it's positive. The other type of capital call that actually does have a negative connotation is the one where the sponsor sees that their asset is in trouble and they're not able to continue managing it or working on it the way it is. They're in red, they're in negative, and so they need to bring additional money in to save the project. It could be for multiple reasons. It could be because of mismanagement. It could be because of turnaround of employees. It could be because of the weather conditions, or numerous other reasons. But the main thing is they did not have enough reserves, and they need to bring additional money to save the asset and hopefully save yours investors' money. In this case, there are a few things that you can do ahead of time to determine if something like this will happen. Well, first of all, read the PPM, read the private placement memorandum, and see if the capital call option is even mentioned there. Second of all, capital calls could be optional or required, so make sure you understand and read that in the PPM, or ask a sponsor if they will have a capital call. Would it be required or would it be optional? That's important. Also, as I mentioned, check the deal reserves. Does the sponsor have enough of the rainy day funds money that they may use to salvage the asset? Also, assess the leverage. Is the debt structure conservative or too risky? Do they have just a single loan with a bank, or do they also use mezzanine debt or something else in between? And unfortunately, in this case, I also have a real life example where there was a self-storage deal that was going south, and due to miscalculations of the money needed for the value add component, investors had to contribute additional 20% of the money into the project, or they were risking to have their equity being diluted. So the key takeaway in this case, always ask the sponsorship team about the leverage structure, ask them about the reserves they have, and ask them about any potential capital calls before investing, whether they may or may not happen, and if they may happen, are they documented in the operating agreement and PPM, and would these calls be potentially required or not? And ask them about the consequences, just like I mentioned that, you know, the investor's share could have been diluted if they didn't contribute to that capital call. That's very often the case. If you're not contributing, then your share of ownership in the investment may potentially also be diluted as well. Pitfall number 5 is lack of transparency and poor communication. And unfortunately, it is the case nowadays where you call the sponsor team, email them, they always respond to your calls, your texts, emails, and then once you invest the money with them, you don't hear from them for a very long time. It does happen, not all the time, but things like that happen, and it's a big red flag. So the best ways to avoid this from happening is ask the sponsor team upfront, what is the reporting frequency? Is it monthly, annually, quarterly? Should you anticipate receiving the updates on time? More importantly, also is check the past experience that they offer to their investors. Were they actually providing such communication on time? Was it clear and concise? Also ensure the financial transparency. Do they provide you with the real numbers or do they just show the marketing fluff? And again, in this case, I do have a real life example to share where the investor invested in a syndication and expected to receive quarterly updates. After the first year, the sponsor became completely unresponsive, then paused the distributions without any explanation, and the investor had no choice just to wait for years to see what happens because they couldn't get a hold of the sponsor. So the key takeaway in this case is, number one, transparency is absolutely non-negotiable, and always verify the past performance and ask for the updates that the sponsor had sent in the past for the past projects to see if they're actually telling you the truth, if they are providing timely communications, and also to see the content of the updates. Do they give clear and concise data about where the asset is, what's going on, and showing you everything, the good, the bad, and the ugly? Or are they only concentrating on the good stuff? Oh, we filled the vacancy and now only have 93% occupancy. Or are they also showing you, oh, we are in the red and we need to pause distributions for such and such reason, but we will assure you that as soon as we're able to start distributions, not only will start them, but we'll also catch up on that pref that we promised you. And again, making certain stuff up just to show you that there is a big difference between providing clear and concise communications and providing communications that are wishy-washy and don't give you the exact details as to what's going on with the asset. Another way to check it is to also speak with the sponsor's past investors. If someone invested with the sponsor in the past and can tell you upfront that, yes, I've invested with them and we went through multiple exits and I've seen my returns, that speaks volume. In that case, you definitely know that, yes, that's the sponsor that you want to invest with because someone else without any solicitation is giving you positive feedback and positive information about the sponsor. I'll pause if there are any questions.
I do not see any questions in the Q&A or chat. People must be a little bit shy today, but yeah, I highly encourage people to post their questions for Alina while we have her time.
Sure. Okay. That sounds good. And I realized that I didn't provide any bio or any information about me, but just to give you a high level overview, I had a 20 plus years of successful career. I started my career as a tax accountant with Big Four, quickly realized that taxes and accounting were not exactly the fields that I wanted to spend most of my life in. So I jumped into information technology, where I had a very successful 20 plus year career. And I also worked in a private equity firm as a head of investor relations. At this point in life, I'm a full-time investor and entrepreneur. Teach and coach other people how to become successful passive investor. And I also do a lot of volunteering locally in my community and in one of my alma maters at Rutgers, where I coach and mentor students on career development. So that's pretty much in a nutshell what I do.
Thanks for that information, Alina. We do have a question that came in when you were about to start not your introduction, but your
Please
bio.
go ahead.
The question is from William. He asks, "What is a reasonable return to invest in a syndication?"
It's a good question, but the answer, as my tax professor in college used to say, is it depends. It depends on multiple factors. Number one, it depends on the type of strategy that the operator is executing. And by the way, words like sponsor, syndicator, operator are often used interchangeably, and I use that as well. So the core strategy versus core plus versus new construction will produce or will even offer very different returns. Besides that, if you're investing in a single asset syndication versus a fund, the returns also are going to vary significantly. Another factor that's very critical to keep in mind when looking at the syndication is where the market is. We 2021, 2022 were incredibly great years, and even bad sponsors were producing good results because of the environment we were in. We're in a much tighter environment right now, so obviously the returns have subsided, and we just need to ride this windfall until we're in a better environment. But all of that has an impact on the returns and what you may potentially expect. And another point to keep in mind is also a lot depends on whether investing in a project that offers equity or debt. Debt is more often than not set return where you can get 8, 10, 12 or whatever percentage is from your investment, where equity, the sky is the limit. Obviously, it's not going to be 100%, but the percentages vary significantly depending on all of the factors that I just mentioned and more. William,
Great.
does that answer your question?
That seems to answer it very well. Thank you. And we actually had two more questions come in as you were giving your answer for that. Three
Excellent.
now.
Go ahead.
So Marcella asks, can you explain the concept of the cap rate in multifamily investments? How use that in how do I use that or how use that in the financial assessment?
Don't. The answer is simple. Don't. I would not recommend using cap rate at all. If you're evaluating an investment, let's say it's an apartment complex, this is one of the most common assets that people invest in or seem to be the most common one on the street. Look at the underwriting. For example, if the sponsor is presenting underwriting in the marketing materials, great. If not, then you can always ask for it. And the simple way to do is to look at what they're projecting the rents are going to be in the area. Are they projecting the increase of the rents? Is this increase drastic or is it slow? And when I say slow, I mean, is it 2 to 5% every year, or are they saying that they're going to jump the rents from today until next year by 20%? And maybe it's possible in a great market, great environment, but we're not in that environment to increase the rents by 20%. And how you can verify that's also very simple. You can go online and search for that specific geographic area comparable apartments. Always look at the type of the building you're searching at. So, for example, if the offering that you're presented with is a high rise, then only look at the high rises in the area. Do not compare it with a garden style apartment, which is like a 2-3 story apartment. So you need to compare apples to apples. So the asset that you are considering investing in need to be compatible with the asset that's located in this area and is a similar type of asset. So it's important that it's a similar type of asset. The age of it is also important, but you have more options in here. So if the assets are, let's say, 10 to 15 years apart, it's still okay. But you can't compare an asset that was built in, let's say, 1980 to an asset that was built in 2005. That's a huge difference. And the pricing will be different, the amenities will be different. So all of that is important. And obviously, it will require a little bit of time. But now with AI available and all of the resources at your hand, it should not take more than a day to do this type of research on the asset. And the same applies to expenses. Just like you would be looking at the rent increases for a particular property, look at the expense decreases, because what the sponsor is ultimately trying to do is they're trying to increase the value of the asset overall. For commercial real estate, the value of the asset can be increased in one of the three ways. Number one is increasing income, which we just talked about, increasing the rents. Number two is decreasing expenses, and I'm going to cover it in a second. And number three, doing both at the same time. So when it comes to expenses, the same thing. Look at the underwriting. Are the expenses going down significantly? If that's the case, then ask the sponsor, how is it possible? If they're staying the same or increasing, that's fine. But if they're increasing by a lot, ask the sponsor, why is that happening? So always ask sponsor the questions and see if they're giving you a reasonable explanation to what they're projecting and how they're evaluating a particular asset. So I hope that answers the question. And
Yeah.
William, I think you said there was another one.
There's actually two more. Oh,
Okay,
three
good.
more.
Good,
So
good. Yeah, that's what I wanted. So please
perfect.
keep them coming.
So next question is from Norm. He asks, for lack of transparency in communications, what legal steps, if any, should an investor take if they suspect some level of fraud due to lack of communications, and what type of attorney as well?
In terms of the attorney, uh, it's hard. It's a fine line depending on what's happening. You can probably reach out to either business attorney or securities attorney. In terms of the legal actions, unless you see the sponsor breaking their fiduciary duty, and how can you tell if they are? Well, if you suspect something is happening, or if you've seen or heard something is happening, then again, go back to the PPM, the private placement memorandum, and see how those fiduciary duties are described, see if the sponsor is failing to follow those duties. If that's the case, then, or if you suspect something, reach out to SEC. I believe the SEC website has a page where you can either submit a case or you can reach out to someone. I don't know if they have an automated machine or the actual person will pick up the phone, but they'll get back to you. Like, basically you start with submitting a case and then letting them look into the case and see if there is any suspicious activity going on. Does that
Perfect.
help?
Yeah, perfect. Thank you for that. Thanks for the question, Norm. Next question we have is from Edward. He says, I've been a real estate investor for over 40 years and I was wanting to liquidate my properties. Is there any outlet that is available where these could be so syndicated?
Um, and I'm sorry, did Edward say that he is the owner or he's part of the syndications?
There wasn't any clarification for that in the question, but it sounds like he's the owner.
Okay, if Edward is the owner and the goal is to sell everything and potentially not pay taxes on all of it immediately, but rather delay it, one of the options is DST, meaning that you sell all of your assets and instead of buying something and being an active investor, you move all of the proceedings into the DST, and that allows you to defer paying taxes on capital gains until much later. DSTs are completely passive and you don't have to manage it, and the duration is very different. Some may last as little as 3 to 5 years, some may last as long as 5 to 10 years. So that's one option. In terms of selling the assets, it's totally up to you whether to sell it individually or to sell it as a portfolio. And if you do want to sell it as a portfolio, reaching out to broker that's active and knowledgeable and knows the area well is the best. How do you find such broker? Look for the brokers online and see which one of the brokers or brokerages had the most number of transactions in your local area. Usually, from my personal experience, the local brokerages are much better choice. The brokerages that are located in your area and have brokers that know the area really well and can present your asset in a way that will be sellable and can help you go through the process a lot faster. I hope this helps.
Perfect. Thanks for the question, Edward. Thanks for the answer, Alina.
Thank you.
And we have one more question from Marcella. Can you please explain the concept of cap rate in these types of projects? And it's brought up often in the pitches.
So yeah, a cap rate more often than not used by investors, and usually it's used to assess whether the investment itself is worth looking at or not. But it's a very, very quick indicator. It is essentially a real estate metric that would tell you on a very high level the rate of return on your investment property. And the way it's calculated is you take the NOI and you divide it over by the purchase price. It's the initial indicator that tells an active real estate investor whether they would want to consider evaluating and reviewing this property, but it's not by any means a metric that should be used actively and excessively by any investors, because there are many factors that go into that rate, and one of them being the purchase price. I'll give you an example. For instance, I'm located in New Jersey, where cap rates vary anywhere from 3 to 5%, where if we were to go to, let's say, Ohio or Michigan, the cap rates are most likely going to be anywhere between 7 to 10%. Does it mean that 5% versus 7% is a worse rate than that? Not necessarily. A lot depends on where you're located, where you're buying, and your personal circumstances. If I, for example, again, had a property that I was selling and I didn't want to pay taxes on it immediately, I would search for 1031. And if that 1031 was presented through a project that was 4% cap rate and I didn't want to pay taxes, I would probably go for it. But that's why cap rate is that discretionary terms that I usually try to shy away with. And I also tell investors not to look for it, and you can look at what it is, but it's not going to mean a lot to you if you're not buying the asset actively yourself. Hope this helps.
Great. Thanks, Alina. Thanks, Marcella, for the question. One more question came in from Angela. She wants to know, what is a DST?
Good question. So DST, I forget what it stands for. I should have. So there are actually two terms for DST. One is that used with the 1031 exchanges. I believe it's called Delaware Statutory Trust, but definitely check. I think the one that's called Delaware Statutory Trust is the one that's used for the 1031 exchanges, where, as I said, you sold the asset and you are trying to postpone paying taxes on it. So you take the proceedings of your asset and you put into this DST. It works sort of like a syndication. I mean, the legal structure may very well be the syndication, but in this case, you're not the one responsible for managing the assets. And by the way, speaking of just regular syndications, they may at times allow for people that have 1031 money to bring that in if they have a structure called TIC, TIC stands for tenancy in common, TIC. So if a syndication structure has a TIC allowance, then you can bring your proceedings from the sale of your property into syndication. Excuse me. And that will allow you to, again, postpone paying your taxes until later date. In this case, you would be dependent on the sponsor deciding when to sell the asset. And in that case, again, you can continue postponing your gains by continuing to invest with the sponsor, or you may decide to cash off and pay the taxes at that time. I hope that answers the question.
Perfect. And that's all the questions we have at the moment.
Perfect, because I do have a few more slides, and I think, yeah, we have about 15 minutes, so I want to make sure I get through everything.
Perfect.
But great questions, guys. Continue sending them, and I will try to go through the rest of the slides, and it's not that much, rather quickly, so that I can answer a few more questions at the end. So I wanted to make this a little bit more interactive, and I got this poll out. It's not the actual poll, as you know, you're not getting a pop-up to answer, but I'm just curious in general. As an investor, what is your biggest challenge? Is it sponsor trust, understanding the deal metrics, assessing the risks, or is it something else? Would love to hear. And please just feel free to type it in the chat, and will share with us.
Donna says all of them.
Oh,
Marcella says sponsor trust. So far, that's all we have at the moment.
got it. Okay.
Norm says trust and risk.
Got it. Okay. Okay. Well, it sounds like we've covered some of them, and again, all of them. Okay. If these are still the questions, I'm going to be providing you with some resources in a little while that will hopefully help you to better evaluate deals and be able to better assess the risks. So what I want to do next is I want us to go through a quick hypothetical example. I'm going to share an investment that a passive investor is considering, and I'm going to ask for your thoughts on that investment. So here's the scenario. Sarah is a high-earning professional looking for passive income. She was pitched a deal with 20% IRR, 8% pref, and a 3-year exit strategies. Sounds too good to be true, right? The sponsor said that the market shows 5 to 7 year growth projection. The duration is only 3 years, and the sale is projected at 30% appreciation rate, which is phenomenal for 3 years. And the sponsor does not anticipate to have any capital calls because they offer the conservative underwriting. And I'm sure you've seen the word conservative underwriting more often than not in the marketing materials. Don't rely solely on the marketing materials. My suggestion is to always read the PPM and ask the sponsor questions about the PPM. And in this case, in this example, Sarah invested 100 grand in this project. So what happened afterwards is not that much of a pretty picture. So market assumptions were very aggressive, and the sponsor assumed the above average rent growth without factoring in potential economic downturns. Sponsors had no prior syndication experience. The sponsor experience was in consulting and construction, but they never took the project from the beginning to an end. The reserves were low, and then the unexpected capital call followed. Within a year, the renovations were costing more than expected, and the capital call was put upon investors, and investors had to contribute 15% more or face the dilution. And then the communication became very sporadic. After the second year, the investor reports became very infrequent, and the distributions were stopped without any clear guidance as to when they would be restarted. And the next point was that the exit strategy collapsed completely due to the market conditions. When it was time to sell, the interest rates went up so high that the property did not appreciate at all, and the investors had to hold this asset for a very long time without having any access to distributions of their capital. So how would you trust a sponsor with such investments? I would love to hear your thoughts in the chat, and I'll give you some additional food for thought. When you're going through an offering like that, the potential questions that you should be thinking of, like when I'm evaluating a deal, what are the potential red flags? What are the red flags that Sarah overlooked? Or what are the things that she should have asked the sponsor about? What are the key due diligence steps that should have been done to prevent this from happening? And also think of while you're asking the sponsor questions, based on the responses that you're receiving, what are the additional questions that you should ask that will get you a clearer picture as to how this investment may potentially play out? So I want to hear some feedback. Guys, again, feel free to type in the chat and we'll have Will read it to us. But the key takeaways from this quick use case is always verify the sponsor experience with their previous deals and exits. Ask them if they've gone through multiple cycles. Challenge the return projections and their financial assumptions, and ensure that they have multiple exit strategies. And last but not least, always ask the sponsor how much reserves they have. Ask them how much reserves the bank requires and if they are keeping any additional reserves on top of that, and ask about the debt structure for a particular project.
Great. We
Well,
have we have some comments from Jim. Jim says it appears she didn't do anything you just spoke to us about. And then
right.
Marcella says red flag, strong returns and appreciation numbers. She didn't do a LinkedIn and Google search of the sponsor.
Excellent. Thank you. Thank you, Marcella, and thank you, Jim. Great points. Very good. Anything else?
Norm says personally would not ever invest with first time sponsor, just super conservative.
Okay, okay, good point. Yes, it's definitely a higher risk investment when the sponsor is completely new. Typically, such sponsors go to friends and family, someone who knew them from the past. Another way to avoid that is for that sponsor, not for you as an investor, but for that first-time sponsor, is to partner with someone who has the track record and experience and can provide that experience while working on a particular asset. Okay, I think I have one or two more slides. Will, is there anything else?
Yeah, Norm also added that he would always ask for examples of how they get out of a hole, cap calls, etc.
Excellent. Thank you, Norm. Excellent point. So as far as the action plan, here's what I'm gonna provide you with. I'm gonna give you two downloadable forms. One is gonna be a sponsor due diligence checklist, and another one is gonna be risk versus return template. The link that I'll give you will also allow you to subscribe to my newsletter that provides valuable insights and resources about real estate investing, economy, and some occasional offerings that come our way. But I think the next page is going to give you that. So feel free to either scan this QR code or grab this link. It's my website, samofinancial.com/mistakes /. I'll give it a minute or two. And that pretty much completes our presentation. The last slide will just have my contact information for anyone interested to reach out. And we are back to the Q&A time. So Will, if there are any questions, please feel free to read them.
Yeah, perfect. Great presentation. Really appreciate all the in-depth information. At the moment, we do not have any questions in the Q&A field or in the chat. Again, can't recommend enough to ask Alina questions while we have her live, because what you might be thinking or curious about, somebody else is most likely also curious about in the chat and they haven't asked it yet. So, highly recommend you speak up and use your time.
Excellent point. And if we're done with this, the last slide just has the contact information. And folks, you now have the tools to spot the costly syndication pitfalls before they happen, but knowledge alone is not enough. Success always comes from applying it the right way and having access to the right opportunities. So if you're serious about building wealth through passive real estate investing, then I highly encourage you to continue educating yourself, find like-minded investors, join the forces, work together with other investors to review and evaluate the deals. And if you think that I can help you in any way, feel free to jump on the call with me. I'm providing the link to my calendar here. You can also find me by emailing me or on LinkedIn. And this is just a shortened version of LinkedIn. If you just go on LinkedIn and put my name, it'll come up as well.
Perfect. We do have a question that came in from Jim. He asks, "Have you ever been treated dishonestly in an investment?"
Unfortunately, yes. Yes, I have been a victim of a Ponzi scheme, and that's still ongoing. So I can't really speak about the details because there are legal proceedings that are active at this time. But I will say, Jim, not that it's answering your question, but I have been on both sides of the investment as a sponsor and as a passive investor, and it helps me to better understand the approach that active and passive investors take in both cases. That does not diminish the responsibility that sponsors have to investors with their fiduciary duties. They still have to be honest. They have to stay on top of things, and they have to share not only the good, positive news, but also the negative news. If something happens, let's say it's a natural disaster and the property is in the negative, that needs to be shared with the investors. The investors need to know what's going on. But for passive investors, as a sponsor, I will say this: please understand that real estate investing has its own risks. It's not guaranteed. If someone tells you that the investment is guaranteed, run away from them, because there's nothing guaranteed. And again, as my tax professor used to say, there are only two things in life that are guaranteed: it's death and taxes. But investments are not. There are always risks involved. Your goal as an investor is to understand those risks, ask the sponsor appropriate questions about the risk, and more importantly, ask the sponsors what is the risk mitigation strategy they have in place to mitigate those potential risks. And that should give you some sort of peace of mind that yes, the operator is on top of things. They know that there are potential risks that may happen, and they have a plan in place that they are going to execute if those risks potentially come up.
All right. I think that may be all of the questions. So I want to thank you, Alina, so much for your time and sharing your wealth of knowledge with us today. I want to thank everybody who's attended or watching this recording in the future. The recording will be sent out to all registrants within the next 24 hours. So if you want to watch this again and really soak in the knowledge a little bit more, highly recommend you do that. If you have any questions, please reach out to Alina. Obviously, she has so much information that she can provide. And if you have any questions about self-direction, do not hesitate to give us a call at Camo Plan. We're happy to help.
Awesome. William, thank you. And thank you everyone for your questions. Excellent questions. And for joining us live and for listening to the recording later on. Have a great day, everyone. Bye.
Everybody have a great day. Thanks.